Hi, everyone, and welcome to this episode of Money Moves. Every episode, I go over a couple of news articles that are the most relevant to me. And for this episode, I want to talk about the new projected deficit numbers for 2021, going all the way through 2030. Then I will talk about the chart for the federal debt going back to the 1970s up into the present. Then I will go over each of my investing accounts, starting with worthy bonds. Then I will talk about Yotta Bank. Next will be GroundFloor, followed by Fundrise. Next will be my retirement account, followed by my taxable accounts with M1 Finance. Then I will finish up my investments with my options portfolio and newly introducing a little bit of crypto. Then I will go over my bi-weekly tracker. And finally, for this episode, of course, there will be some jelly at the end, which is something I enjoyed outside of the markets. If you have big dreams like owning the newly announced Bugatti 110, or if you're just getting started on your financial journey, definitely like and subscribe. This car is not quite on sale yet, but it is expected to sell for $9 million each. Thank you guys for all the support and helping me get to 200 subscribers. Welcome to the Portfolio Bulletin. Let's get started. The deficit for 2021 is expected to be $2.3 trillion, which is about 50% higher than what they take in on an annual basis, which is usually between $3.5 and $4 trillion. It's worth noting here that they say this overrun does not include any additional stimulus, so if the $1.9 trillion stimulus that is being talked about gets passed, it will increase the deficit to over $4 trillion. And based on the discussions, it seems very likely that that will be passed, making it the highest shortfall in the country's history, surpassing last year's shortfall of $3.13 trillion. All of this will increase the federal debt to $35.3 trillion by 2031, which will be the largest debt to GDP ratio in U.S. history. So I talked a few episodes back about how the government was spending like drunken sailors, and that I wasn't sure if we could continue to spend and stimulate the economy the way we have been last year going into this year, and if we could afford to raise the minimum wage to $15, which would definitely cost us some jobs in the short term at a minimum, and this is the reason why. Eventually, if not this year, the government will run out of money and it will devalue the currency so heavily that we will see some inflation as the economy continues to open. I know that the Fed continues to say that they will tolerate higher inflation rates, but I'm not sure they're fully understanding how high of an inflation rate this could potentially produce. The percent overrun for just 2020 was 14.9%, and it's projected to be around 10.3% for 2021. Again, not including the $1.9 trillion, which is most likely going to pass. The vast majority of the overruns last year came from the CARES Act, as well as the additional $900 billion passed in December, totaling the $3.1 trillion that I mentioned earlier. Then they throw out some numbers here on what percent of GDP it's expected to be going forward, at around 100% going into the end of 2021 and 107% by 2031. Not sure exactly how accurate these numbers are, as I will show you in the chart next, but these seem a little bit understated. They do mention here they expect the economy to continue to grow at a pretty rapid rate, 3.7% for 2021, with continuing growth through 2031. Looking at the chart here from the St. Louis Fed, you can see we're already hovering over that over 100% level, somewhere between 103 and 105%. And then here in Q2 of 2020, we got up to 35.6%. We had a slight decline going into Q3 because the economy did start to recover, thus increasing GDP. I also want to highlight here, all of these shaded areas are where we've had recessions. And you can see here in 1981, spending increased substantially, and the spending continued to increase through the 1990s. And then we had another small recession, which we then continued to spend, followed by a little bit of a decrease. Then we had 2008, the massive recession, where we spent huge amounts of money at an unprecedented rate. And then it seemed like we were going to taper here. 2015, we did not. We continued to stay flat with the spending. And then we came into the Rona situation, where we again massively increased our spending. The point here is that we've already reached unprecedented levels, and we continue to shoot higher. And I'm just not sure what this is going to do to the economy. And if you have any questions about why the market continues to sit at all-time highs, This is the reason why. We have spent a huge amount of money recently, and because we continue to borrow at these rates, it makes sense that the market would sit at a higher price to earnings ratio than it has in a while, because there's so much more money available, and I think more money than we would like to admit is going straight into the markets, causing inflation in market prices. But the question is, once all of this spending does hit its upper limit, if we even say that there is an upper limit, what will happen to market prices? And potentially at some point, I do hope that they start to pay back some of these loans in an effort to reduce this ratio. That may be optimistic, but who knows? I want to go over here to the debt to GDP ratio chart. The graph doesn't go back far enough, but I want to mention that the last time we were at these ridiculously high levels was just after World War II. You can see we were at 114% at the end of World War II, and then we had some budgets to combat a recession and boost the economy. And then after that, we trickled way down all the way into the low 30s, in the mid 70s, despite going through the Vietnam War at the same time. And then since then, it's basically been straight up, just at varying rates, all the way up to 136% at the end of 2020. Of course, we also have the Fed balance sheet here. You can see in 2008, it was sitting at just under $1 trillion. And since then, the Fed balance sheet has continued to increase. They finally started to decrease here in 2018, which is where we saw that drop in the markets. Then we had the Rona, and we've increased this all the way up to over $7.4 trillion. So this number is not included in the numbers that I was talking about before. That's just the federal debt, sitting at over 27 trillion, with potential to go to 35 trillion. And then we have another 7.4 trillion here on the Fed balance sheet, which is not considered debt to the government because this is money loaned either to the government or in the form of bonds as they continue to buy from corporate entities. Basically, the government has become a massive money printer, whether it be printing out money from the Fed to give to companies to keep them afloat, or just handing out checks to the general populace. It does seem a little bit unsustainable. I definitely think that some of the stimulus was warranted and that the additional unemployment benefits that were started to begin with were definitely necessary. But the problem is, once we go there, we never seem to pull back at all. You can see the Fed balance sheet did try to come back down, and then it kicked back up. Even before we hit the Rona in 2019, going into December, it started to rise again. And then as soon as we hit the Rona, it went straight up. We continue to spend money, and even in the good times, we don't try to reduce this balance sheet when we should. And we also don't reduce the federal debt when we should. It's like they never go through a debt cycle to where they pay back any of the amounts. They just continue to spend and hope that the economy grows to catch up to the amount that they're spending. Moving on to the US sentiment chart, it's worth mentioning here that the sentiment is pretty high at 19.19%, with the high point happening here in November at just over 30%. Historically, those have been the highs, and anytime we get into those highs, we tend to see a sell-off. And we've been up here for a little bit now, and it seems like we might get a little bit of a retracement. They did recover from a little bit of a dip, and then they've been flat since then. And if we're not continuing up and we've been flat, this tends to bring in sellers, in my opinion. So just keep that in mind as you continue to invest in stocks. And looking at the Fear and Greed Index on CNN Business, you can see we're on the greed side of the chart. And generally, you don't want to be buying when people are greedy. You want to be buying when people are fearful. And looking at the S&Ps, you can see we're well above the 125-day moving average, which would put us into the extreme greed side of things. I'm not telling you to sell your stocks, but it's definitely something to think about as you continue to invest or trade stocks in the market. All right, moving on to my investments. Looking at worthy bonds here, I did get another person using my affiliate link down in the description, which is great. If you're interested in this platform, there is a link in the description that will get you one free bond. As for the future of this account, I'm going to start drawing this amount down. I think 10.5 thousand is a little bit too much. I chose this value because it allowed me to earn one bond per week at the 5% annualized rate. In looking back, I think this is a little bit too much capital to have available. I really want this money to fund things like my IRA for this year, as well as go into things where it will potentially earn more money. Between Worthy, my savings account, and my taxable stock accounts, I think it's a little bit too much money that is in theory liquid. So my goal is to reduce this to somewhere around 7,500 or 8,000 and move this money out of here for now. Moving on to Yotta, again, I'm going to reduce this value down to 3,000, and I think I'm going to keep it right at that level going forward. I also want to mention a new feature here, this pool option. So if you click here, create a pool, you can make a group of your friends, and this will allow you to generate more chances to win. So if you do have Yotta Bank and you want to join my pool, I am the admin and I've created the Portfolio Bulletin pool. And I believe you can just go in here, and if you match this exactly, you can request to join this pool. Comment down below if you're going to try to do this and how it works. I haven't had anyone try to do this yet. As you can see, I'm the only member right now as I created it this week. But it would be really cool if we could generate a Yotta pool that makes us all a little bit of money. In terms of returns here, you can see I continue to generate over 1% at an annualized rate. And I don't think I've dropped below that, maybe slightly below, but I've always exceeded the national average in terms of high yield savings, which is currently sitting around 0.5 to 0.6%. Moving on to GroundFloor, you can see I continue to invest $30 in every single loan that becomes available, and I will continue to do this until the money from my lending club account goes basically down to zero. If I don't get new loans at a rate to where I can continue to reinvest, I might move some of that money into other investments, but for now, this is where all of that money is going. Looking at my holdings here, you can see I have a little bit of extra cash on hand already, just because they don't put out loans all of the time. I've invested in 56 loans so far, totaling just over $1,800. And for that period, I'm expected to earn just over $141, assuming that there are no defaults. And then looking at the holdings again, primarily C, right at that 10%. But I'm still not discriminating as I continue to put $30 towards everything, which I will do for the foreseeable future. Moving on to Fundrise, it continues to grow, just over $29,000 now. If you have an account with them, be on the lookout for your tax packages. Your dividend packages and in packages are already done. But if you are over that $10,000 mark, you will receive a K1 tax package, which will be available in mid-March. This is one of the downsides of having over $10,000 and being in this advanced level. You do have to file a K1, which is a little bit of a pain because it is a non-standard form. I also want to mention here that if you go into the Performance tab, and you had holdings in 2020, and then you go to cash in or out, it would show you had a pretty substantial withdrawal. And this is because they merged those funds that I talked about before. If you look up here, they had funds that merged into the Fundrise eFund here. But the way that they process this is as a redemption of those funds and then a reinvestment. So it looks like I've invested more than I have here at just over $30,000, but this is not true. This is just money that was moved from one fund to the other, so don't get concerned if you see this on your account. Otherwise, for the future of this account, I'm going to continue to do my monthly deposits. Again, my goal for real estate as a whole is to get it to around 25 to 30%, and this is my primary method of doing so. Moving on to my retirement account, no changes over the last period. I'm continuing to buy more of the total stock market than the S&P 500. And overall, I've reduced my contributions to this fund as I am trying to fund my individual Roth account with Tastyworks. And all of the money that was going here is now going there. Moving on to my M1 Retire account, you can see I got enough dividends to reinvest that money. After receiving $21 over the past month, the markets went back up after their little dip, but have been basically flat since then. Looking at the individual sectors, tech did rebound pretty heavily. Industrials were down a little bit, and healthcare was down a little bit, and telecom continues to be one of the worst performers. In terms of companies that are paying out, I got money from Main Street Capital, Clorox, Apple, American Express, and Lowe's. And you can see I utilized my M1 Borrow here. And all of this money went into my Roth IRA to make sure that I filled my deposits for last year, which you can make all the way up until April 15th of this year. Looking at my higher yield savings account, you can see we're up just over 1%. Got some dividends, everything's looking good here. Bonds underperformed a little bit, and then DIV has had such a meteoric rise. I'm not surprised it had a little bit of a downturn here, and then corporate debt was down also at 1%. Not quite sure how this is true because the Fed continues to buy long-term corporate debt, but it's interesting to see. And taking a closer look at M1 Borrow here, you can see I borrowed all the way up into the limit here to make sure that I could fill the $6,000 in my Roth IRA with Tastyworks. And similarly here, I didn't borrow all the way up into the limit for Retire, so I have a little bit more cash available if I need, up to $1,200 more dollars. And this is all borrowed at a 2% interest rate with M1 Plus, which also gives you a 1% return on your checking account. To me, this is a great resource to have in your back pocket as another way to have emergency money available at a very cheap interest rate. Of course, I'm using it right now for my IRA, as I mentioned, but I will pay this down aggressively going forward in the next few months. Moving on to my options portfolio, continue to trade GE. I will be wheeling this stock for the duration of the year. Definitely check out that series if you're interested in what the wheel strategy is or just how my results are going so far. But mentioning a few of my larger stocks here, Yeti did have a good dip, and I think it's a good trade going forward. And if you're interested in a more detailed description of all of these positions, definitely check out my options portfolio overview linked above. But the main thing I want to mention here is I finally started buying some cryptocurrencies. Very, very small amounts, but this is something that I want to continue to increase over time, getting it to at least 1% of my overall portfolio, if not closer to 2%, which would put the value somewhere between $2,000 and $3,500. Right now, I'm just buying all of the major coins to get some diversity, and then I bought some Doge just because everybody's talking about it and who knows what's going to happen. Plus, it's so cheap that you can get quite a lot of coins for the cost. I will continue to buy these major coins. I'll probably add Litecoin to this as well, but this is a new part of my portfolio, and I plan to continue to add to it. Looking at my Tastyworks portfolio, I did get this up to the 6,000 for last year, you can see here. And I did start trading the Russell 2000, and I might take one other position, but for now, this is going to be my main position for this account. Otherwise, you can see I've done very well over the past few weeks, and most of my positions are in a profit here. Just a few losers like gold right now. Looking at the watch list here, even Tastyworks finally added cryptocurrencies to their platform, where they have Bitcoin Cash, Bitcoin itself, Ethereum, and Litecoin. I may or may not buy some coin here just to spread it out. Robinhood is a little bit sketchy sometimes, but the main point here is that basically every mainstream broker is now allowing you to buy these kind of coins, and with more availability becomes more liquidity, and it seems like this is going more and more mainstream. And with that, it's only fair that I add it to my portfolio as just another way of diversifying, which ties into what I mentioned before with the federal debt, money printing, the Federal Reserve, all of those things causing potential for inflation. And it seems like this is the new gold in the same way that it hedges against inflation. Looking at my tracker here, you can see the markets are at all-time highs, plus my contributions to my retirement account. Trading account is way up because I did add a lot of money to my Roth IRA. Of course, it looks like a huge increase here, but most of that is borrowed money, and I will have to pay that back here in the next few months. Bonds starting to trend up as I continue to add to GroundFloor. REITs continuing to trend up slowly. And then Lending Club continuing to trend down until I withdraw all of that money. My cash has been basically flat. I still want to get this down a little bit as I still sit a little bit too heavy in cash. And looking at my returns here, you can see bonds are up, stocks are up, REITs up, Lending Club trending down, cash up a little bit too much here, trading up quite a lot again because of my contributions. And overall, I'm up 8.87%. If you like any of these platforms, make sure you check down in the description for some free stuff if you plan to open up an account with them. Comment down below what you think of the federal government continuing to spend money aggressively, as well as the Fed balance sheet continuing to go higher. Let me know what you think of any of my investment choices or my current goals with my portfolio. I do this video every 2 weeks, so make sure you like and subscribe so you can keep up with my portfolio growth and the moves I'm making in the future. Of course, none of this is financial advice. This is all for entertainment purposes. And with that, let's get to today's jelly. Today's jelly is Kevin James going on Hot Ones. If you've been watching my channel for a while, you would know I'm a fan of this show. Hot and spicy wings seems to be the great equalizer. When you make celebrities eat them, you kind of see a little bit more of who they really are. Plus, Sean Evans is a great interviewer, and he always asks interesting questions. And Kevin James is also a hilarious comedian and a very down-to-earth person. And I thought he just did a great job, as well as being hilarious, as he almost always is. Definitely go check out this episode. It is linked in the description. And make sure you comment down below what you thought of it. Thanks for watching and have a great day.